All right, thanks, folks. It's time to talk about using options to maximize swing trading profits. I am Keith Harwood here for Option Hotline, where research meets strategy. The very first thing I always do is what my lawyers tell me to do, which is give you these disclosures. So all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. I got to give you guys a few moments to make sure you read through this because that's what the lawyers always tell me to do. And I like to listen to lawyers. All right. Hopefully that gave you guys all enough time to just really understand these disclosures. And, the key here is all this is for educational purposes. So don't consider any of this to be a trade advice or anything like that. And then the next thing I always like to do after we talk about the lawyers is talk about myself. So I started in the option pits of the SIBO back in 2005. So I was a floor trader as a market maker, went through the whole subprime crisis, trading options, enjoying the wonderful bid-ask spreads that existed back in those times of enormous volatility. And then as things changed to become a lot more electronic, you guys may have noticed that option markets got a lot tighter. So the edge started to go away from the market maker and started going towards somebody that had a bias in the market. So I realized, okay, well, it was time for me to formulate a better way to do this, this trading with a specific view on how markets need to move. Okay, so rather than just trading bid-ask spreads and getting this wide market, I needed to have a view. And so I went and traded gold during quantitative easing with a view on what direction I thought gold was going to go. And then I went and got my MBA from the University of Chicago and worked for a hedge fund. And obviously the big thing at a hedge fund is I'm taking markets. I have to have a view. Recognized while I was there that technical trading dominates the world. Computers are really dominating the trading world. Okay, so with computers dominating the trading world, it's time for me to focus on the technical element, combine that with the options knowledge that I've got, and generate a really good trading strategy. Because if I have one edge, I can make a little money. But if I have two edges, I can make a lot of money. So almost 2 years ago, I started a Trade Academy to help teach people how to get those two edges. Talk about how to trade options in equities, fixed income, blockchain as it's developing, commodities, and really combine that concept of technical and options trading to generate a significant edge on the market. So that's what we're going to talk about today. I'm going to talk to you guys about what a swing trade is. It's a very simple concept. A lot of you are probably familiar with it. I'm going to talk about one trade setup today. There's a lot of them that I look at, but this is going to be one simple one that I like to trade. How I set my price targets, both in the stop loss and on the profit side. And then we're really going to get into the option stuff because that's where I really get my leverage. I want you to stay to the end so you can get that special offer here, because if you don't stay to the end, you're not going to get it. So it's just that simple. As a reminder for all of you guys, before we even get into what's a swing trade, if you have any questions, feel free to throw them in the chat or in the Q&A. I will answer them as I read through them or at the end, depending upon how they fit in with everything. Because if it's going to be something that I'm going to address in a slide or two, I'm not going to interrupt necessarily. But if it gets to the end and I forget to answer it, go ahead and ask me again. Let's start with swing trading, though. This is basically what I call technical trading. We're looking to capture gains in a stock within an overnight or several week hold. My normal trade is like 2 to 3 weeks. Okay, so I date stocks. I don't marry them. Investors, the Warren Buffetts of the world, they marry their stocks. They're looking for great value investments that they can hold for years until they capture that value. I'll tell you what, I'm not looking for multi-year holding periods. I want to try to make a quick buck and then move on. Why is that? Well, because the fundamentals come out over years. Guys with huge amounts of money like Warren Buffett, they need to find big stories that are going to develop over years because it takes a long time to move a big ship. If you're driving a smaller boat, a speedboat like me, we can just get in and we can get out and we can move to the next trade. I'm looking for guys that are positioning in trades, looking for signals that somebody is building a position, and then take advantage of, the move over the next couple of weeks. Maybe it's a 3% move in the stock, but I can make a lot of money on a 3% move. While guys like Warren Buffett, they're looking for those big long-term trends. So what we're looking for is mostly technicals because fundamentals come out basically quarterly with earnings, and other times they sporadic updates of information, while the technical trade, which is computer driven, is constant. Every single day, those computers are trading. They are moving markets. All right. So as they get those inputs to the market that they are trading off of, they're trying to capture the next move. I'm trying to just ride the wave, take advantage of that move. And then I move to the next wave, move to the next stock, keep moving as long as there are new opportunities. All right. So let's talk about the very first and one of the simplest trade setups that I like to trade on a technical basis here, and that's called the rectangle. So you're going to look at charts and you're going to say, I don't really know. Some of you are great with charts, and some of you are getting introduced to charts for the first time or just starting to get your education going. When I look at a rectangle, what I'm really looking for is a stock that's been moving up and then finds consolidation. What does that consolidation mean to me? It means somebody is taking profits, but we're not pulling back. So it means that even though the market has rallied quite a bit, this isn't a situation necessarily where that stock needs to come down. It's just that somebody sees a better opportunity somewhere else, so they're raising cash by selling out their position. And so what they do is, let's say the stock was 90 and it's rallied to 100, but they like selling at $100. They like to move on. They made their 11% and change. And then somebody below says, I'm still willing to pay 98 because I think the stock's worth 110 and I want to make 11% and change. So you've got this situation where one person's willing to buy, or many people are willing to buy because there's still some value there, and somebody else is willing to sell because they just don't see the value here relative to some other opportunity or at all. Well, then I wait for this to resolve. Because if the guy that's buying for 98 thinks it's worth 110, he may get a little bit more aggressive. And if the guy that's selling at 100 thinks it's worth a lot less, he may get more aggressive. And then as that aggression comes through, what happens? Either the guy paying 98 starts saying, maybe this isn't even worth 110, it's worth 120. And so he gets aggressive and he starts paying 100, and we get through the seller and there's no obvious seller left. So if we don't know where the next source of supply on this stock is going to come, we have to find it. And how do we find the next source of supply? With higher prices. So we push the stock higher. Everybody piles on. All the people that were trying to get short at 100 because they just said the technical pattern said they could short at 100 and pay 98, they're covering. Everybody's scrambling and the stock explodes higher. That creates an opportunity for me, because now instead of having a defined range that I could really chop myself up trying to sell 100 to buy 98, sell 100 to buy 98, and I can make a lot of money on the way. But if that doesn't last very long, I can blow that out on the first move through. It's picking up pennies in front of a steamroller. What I would rather do is wait for that steamroller to move through and then get on board and say, I have the easy path now. This stock's going higher and it doesn't need to stop until somebody else says, fundamentally, I'm done. So if we have no supply and we still have demand, prices clear higher, my options trade can get leverage. On the other side, a stock is dropping. You never want to catch a falling knife. People start to get a little bit more interested when that falling knife turns into stability. Maybe we found that floor. So you get some new people starting to position bullishly, saying, okay, well, finally we found value. But then it breaks lower and everybody just stops out of the position, and that creates a second run of falling. So it's the same concept as on the bullish side, except for it gets to the downside. And that's something I want to be able to be short. In terms of these rectangles, I generally want to be bullish if it's in an uptrend followed by consolidation, and bearish if it's in a downtrend followed by consolidation. We don't necessarily look for this to trade the other way. So if we have had a run and then we start to pull the other way, then it sets up a different technical pattern. What I want is this setup to give me a clear move to the upside where there's no obvious resistance, but there is obvious support. So let's talk about that support. That's how I set my stop loss. So we look at this chart again. If I'm looking to get long here on the breakout above the recent high, what's my obvious support level? It's the previous low. So if this guy got aggressive buying and pushed the stock to a new high, and then we go back down and go through that level, it tells me that he was the only buyer left. Maybe he was just covering a short position, and I have no idea how low this stock can go. It's not necessarily something I want to try to get short because it might just be a quick move, but I don't necessarily want to be long anymore because my thesis that there is a buyer in the market seems to be nullified. And as we create time above the breakout level, then I can use a trailing stop to actually raise my stop level up towards this previous resistance. And that helps create a situation where I'm less likely to lose money. So I always move my stop losses. I talk more about all of that stuff in the course that you're all going to get in your email. It's going to talk to you a little bit more about how to trade some of these setups. It's like, I think it's 8 parts or 7 parts, something like that. There's a lot of information there as well. So I do urge you to take a look at that because I can get in a lot more depth than I can with you today. Let's move to the next stop, and that's the profit target. So we've said that the stop is really going to be initially set here, and then I'm going to try to raise it as time goes on. How do I set my profit target if there's no resistance? I don't know where this thing's going to stop. I don't want to just sell it because it's moved. And we don't have an obvious price point for a stop on the same thing, or for a profit target. And on the way down, I don't have an obvious place where this stock's going to stop falling. So I have to use some sort of other signal other than just using a strict price from looking at the chart. So what do? I use standard deviations. When I was getting my MBA at the University of Chicago, I focused on analytic finance, econometrics, and statistics and entrepreneurship. When I got my undergraduate degree from Notre Dame, I was in theoretical mathematics and economics. So I like numbers. That's another edge that I know I can apply to stuff here. This might be over some of your heads. It might be simple to a lot of you. What I do is I look at what is the likely scenario. Well, when a stock is consolidating, it's sitting in this area. Okay, 68.2% of the time, a stock is going to move somewhere between down a standard deviation and up 1 standard deviation. So if I have a trade that's expiring in a month, I can calculate my standard deviation and say, well, 68% of the time, call it 2/3 of the time, that stock's going to stay within this range. When I get these technical breakouts to the upside, I'm looking for a move into this part of the range. The stuff that's only going to happen 14% of the time. If I've got the direction right, that means 28%. Because if I eliminate everything to the left of this, and I am actually right that this thing's breaking out, this is still only going to happen 28% of the time. So a move to here is a pretty good profit target. Or in a single day, a move to here. How often does that happen? Once a month. Okay, so a 2 standard deviation move up or down happens once a month. That's a pretty good time to stop. So that's what I look at when I'm looking for my price targets initially. Doesn't mean I'm exiting. It means I am setting a spot where I say, okay, I got to review this position because we just had a standard deviation move over the term of my trade or a 2 standard deviation move in a single day. That's where I start my profit taking points, where I'm either aggressively setting trailing stops or maybe just taking the money. Depending on the scenario, there are other setups I trade that I don't go for 2 standard deviations. I go for 3. Because these things that are supposed to only happen 0.1% of the time happen a heck of a lot more often than that. Why? Because the market doesn't actually follow a normal distribution. The events of last week, in the beginning of October here, where the market was, where the S&Ps were down about 90, based upon a recent historical volatility level, that was like a 9 standard deviation move. A 7 standard deviation move is supposed to only happen something like 1 in a billion years. So the normal standard deviation assumption, or sorry, normal distribution assumption isn't quite right. And that's how I can actually get a little bit of an extra edge, in that the marketplace tries to price things as if they have a normal distribution. So these outlier scenarios with the right technical setup can go through. In the one I'm talking about here, I want to focus on this 1 to 2 standard deviation move stuff though, okay? In this, it's still kind of a sweet spot. It's still got probability on my side, and there's a lot of leverage there. Now, where does that leverage come from? The options markets. That is what we get from the options market, right? It's a hedging tool, but it's also a leverage building tool. So a lot of you guys are familiar with options. I want you to bear with me for a moment here, because I am going to talk through options as if you don't know much about it. It's only going to be for a couple minutes. And then I'm going to get into some stuff that even if you're a seasoned professional in options, you're going to say, okay, this is actually an interesting way to look at it, because I don't know that a lot of people approach it this way. And I think you're going to be excited to hear it that way. So I want you to, stomach this with me for a second about how stock and options work together. And then we're going to talk about that amazing leverage stuff. So the very first thing is a very simple trade. Okay. So like trading 101, I'm in a stock for $100 a share. I'm targeting the move to 120 and my stop out is at 90. So I set those from that initial stuff I was talking about. My stop loss was from 90. I said 120 because that was my 1 standard deviation move. I've got some really nice little metrics here to make this play. So if I'm willing to lose $1,000 if I'm wrong, remember, I set my stop loss, my risk tolerance first, not my profit target first. So if I'm only willing to lose $1,000, I'm not going to buy 10,000 shares of this stock and have to stop myself out on a dime move. That's just not logical. That's not right. I don't look here first. I look down here first. Okay. So I say, okay, I've got this $1,000 of risk. That means I can buy 100 shares. That's going to cost me 10 grand. And if I get my 20% price appreciation, I make $2,000. And if I get my 10% price depreciation and I hit my stop at 90, I'm going to lose $1,000. That assumes that obviously that I can make that trade every single day. Every once in a while, news comes out and a stock gaps. Instead of being at 100, all of a sudden I wake up tomorrow morning and this stock's trading 60. I didn't lose $1,000. I'm going to lose 4 grand and I have to get out because I've lost way more than I thought I was going to be willing to. Okay. Let's do it on the option side. Instead, if I want to risk $1,000 buying at the money calls and those calls each cost $5, that's going to cost me $1,000 to buy 2 of them. Why? Because $5 times the multiplier of 100, because each option represents 100 shares, means that each option contract costs $500. So a 2 lot, that's what we call 2 contracts. A 2 lot is $1,000. So if this stock drops to 90 at expiration, I lose $1,000. Remember though, if it drops to 95 at expiration, I still lose $1,000. So I lose a little bit more than the stock position that only would have lost $500 down there. But on the upside now, if a move goes to 120, I make 3 grand. So let's look at these side by side. If the stock goes to 120, I make 2 grand in my stock position. If the options, or if the stock goes to 120, I would make 3 grand on my options. Which one's better? I want $3,000, not $2,000. That's a better deal for me. That's a better payout. So let's dig into this chart a little bit more because it's not as simple as it just looks, as much as you want to think it is. This is the option payout and this is the stock payout. Where's my break-even point? Right there. So you see where the option P&L crosses the stock P&L. Above 110, I do better in options. Below 110, I do better in stock. And in fact, this whole triangle right here is my opportunity cost if things don't go the way as planned. So I can't just buy options and say, I'm going to be fine. And in particular, I don't want to do this with short-dated options because these options that expire in a month, this scenario resolves within a month. If I do something that expires in 2 years, I got 2 years for this scenario to play out, right? I like to focus on those short-term options for those short-term swing trades. So how do I balance out this scenario and this scenario? Well, I got to find leverage. Before I get to the leverage, I want to reiterate the risk part of this because if you take nothing else away from this presentation, remember how much risk options have when used incorrectly. So I started off telling you that I was going to spend 10 grand on stock. And these options cost $5. So if I'm going to spend 10 grand, why not buy 20 of these calls? This is why. Yeah, great. If the stock goes to 120 and I risk my $10,000, I'm going to make $30,000. But if the stock doesn't move, I lose all $10,000. So this is that whole trade-off scenario, right? My concern was the move to 90. And I only wanted to lose $1,000 if that happens. If I put my whole account in these calls and the stock moves to 90, I lose 10 times more than I was willing to risk initially. That is a simple mistake that a lot of people make their first time. You don't make it again because usually people end up blowing out an account doing something like this. So please, please, please do not make this kind of mistake. Compare the absolute risk of your stock position to the absolute risk of your options position. And that's how you get your risk reward ratios. And that's how you determine whether stock is better than options. But it can't just be that simple, right? Because how do I set this 120 price target? It's off of standard deviations. So how do I calculate the standard deviations? Well, the options market actually gives me that information because there's this thing called implied volatility. And implied volatility is a calculation of those standard deviations. And it mean reverts. What does it mean when it mean reverts? Well, if you're looking at a stock, it can go anywhere. We call that random walk. It can go up, it can go down. It doesn't have to come back to where it came from. So just because a stock went from 90 to 100 doesn't mean it's coming back to 90. Guess what? Implied volatility tends to mean revert. Why does it happen that way? Well, because when implied volatility or realized volatility gets high, people tend to leave the marketplace, and that forces prices to kind of consolidate again. So we start losing too much liquidity. People get disinterested. That slows down market movement. And when it gets too low, people stop participating as well because they're not making any money, and that helps widen it back out. So we've got this little scenario where implied volatility goes up and down in waves, but it tends to have a long-term mean value that it shoots back for. This is where the fun comes in. This is where I get to find out if I'm buying options on sale or not and getting real leverage. What if I thought a stock should have an implied volatility of 36%? This is a stock that moves 4 times as much as the S&P in a percentage terms, roughly 3 times, 4 times, something in that range. All right, well then that $100 call that I was talking about earlier is worth $5 if it expires in a month. All right, that was an easy one. 106 call is worth $273, and the 94 call that's far in the money is worth $846. And sometimes there's a reason to use a far in the money call. That's more about the defined risk. 106 call is all about leverage though, and here's where you're going to see why. Let's talk about the sale rack. I go into Nordstrom's and I say to myself, I want something on sale. And then what do? I don't go to the clearance rack and just buy everything that's on the clearance rack just because it's on sale. I see if I find something that I want from that clearance rack. That's what I do all the time, right? I search the clearance rack for something that shouldn't be on sale. So I find these options in this stock that's about to break out to the upside. And we're focused on the upside on this because I'm using calls. And I say, okay, which stocks out there have cheap volatility and have a situation where it's going to break out? Because if that's going to happen, and I can get these calls for 30% instead of 36%, I'm getting them on a 28% discount. If that stock looks like it's about to break out and volatility is at 42%, it means everybody's on this trade already and they are chasing those options. And I'm paying a premium to get in. I don't have to pay a premium to get in. I don't have to play in a name if it's trading expensive. Why not? Because I'm taking markets. When I was a market maker on the floor, I had to trade each of these environments just dependent upon what paper wanted to do. So that retail investor or that big hedge fund, he tells me what he wants to do. And I say, here's the price I'm willing to do it. There is an option, pun intended, for all of us as retail investors. That is no trade. So if I see a situation where options are overpriced and I don't want to sell options, I don't make a trade. But when I see a position where this stock could move at that 42% level because we're getting this weird breakout after a major coil and it's going to get crazy movement, I get to buy my options super cheap. For $1,000 at 30% implied volatility, I can buy 5 calls. For $1,000 at 42% implied volatility, I can only buy 3. So if I think this scenario is going to start up and I'm getting this pricing, I'm buying 3 and getting 2 for free. That's called the clearance rack. That's how I get my leverage. I want options when they're on sale. So I scan 1,000+ options, contracts, equities every day, looking for what's on sale and has a technical setup. Because if I can find something that I think has that technical setup to move to 120 and the options are on sale, look at that leverage from those out of the money calls. We get that move, I make $6,000 plus instead of $2,000. That is huge leverage, relatively speaking. I can risk 1,000 to make 6 instead of risking 1,000 to make 2. On the other hand, if the market has already priced in the scenario, I'm risking $1,000 to make 3 if I'm right. You want to know how to look at this chart the best way? The purple line is stock. Leverage is when we're way above the purple line. The opportunity cost is everything below. So if I see a situation where something like this is occurring, what am I seeing here? I'm seeing an opportunity where leverage is overpriced because there's a lot more area under the purple line than over it. Here, there's a lot of space above that purple line. These options are going to outperform stock. These options are generally going to underperform stock. So why would I go here and pay a premium when I don't have to trade? I'd rather go here and pay a discount when I want to trade. And I get that double benefit of that defined risk because if I walk in tomorrow morning, the stock's trading 60, I know my risk. It was $1,000. If I'm in stock, it's unlimited, well, down to the stock going to 0. Unlikely for a stock to drop from 100 to 0. Unlikely for a stock to drop from 100 to 60, but it happens, especially when you find a less liquid name or something that's got some weirdness to it. Okay. And we see that every once in a while. An accounting scandal comes out of the blue. Nobody really had known about it. Technically, nobody's supposed to know about these things. That's insider trading if they do. So the options can get cheap, even though there's something about to happen. So we look for those opportunities where the technicals and the volatility align for explosive return potential. And that's what I do all day, every day. I look for setups with low implied volatility relative to history. So that 30% vol, it's on sale. It's at the clearance rack. And one of the nice things is that rectangles often lead to low implied volatility. Why? Because the stock's not moving that much. So what are people doing? They're selling options. They're certainly not buying them. They're not getting paid to buy options when realized volatility is so low. So people give up. They don't want to buy options. But then I sit there and say, oh, well, there's a technical setup and the volatility is cheap. I have a setup. I take some short-dated options, 1 month expiration, maybe less, maybe a little bit more. It's a decent target spot. I go to 30 delta because that's going to pay me on a move of 1 standard deviation. And if we get more than a standard deviation, I'm going to get explosive returns instead of just a little bit of cash. Just a little bit of cash ain't bad. It's still making money. But I'm looking for that explosive return profile for that 1+ standard deviation move where I can triple or quadruple my money. So we're looking for implied volatility that's low relative to history. And the historical volatility can do whatever it wants because we're at low realized volatility, usually when we're in a rectangle. But it's all about getting to an inflection point where the stock looks like it can move a lot, getting out of that coil. So easiest way for me to really explain this is to look at some recent examples of stuff that I've traded, okay? But first, I want you guys all to pull out the checklist that you got in your email. If you don't have it in front of you, you didn't get it in your email, go to optionhotline.com/Keith's checklist. Sign up right now. That'll send you the 9-step trading checklist. It talks about all of these steps to setting the trade, and then we can walk through these examples together. It'll take you guys a moment to pull it out. So I'm going to give you a couple seconds here, and we can all take a little breather, maybe have a sip of coffee or whatever you need for a short break. And then we'll get right into these examples because that's where the excitement comes, is actually seeing this in action. All right. Hopefully you all have your checklist in front of you. If you don't worry. I'm going to kind of walk through it a little bit here as we go through, okay? I'm going to go back to a trade I did back in June. Monster Beverage Corporation. Energy drinks. That doesn't sound like anything special where I know anything about the value or the fundamentals, but we had a rectangle trading. Okay, so it was trading in a range between about $55 and $57.30 was the high from June 25th. And on June 29th, 4 days later, the stock made a new high for this recent move. So, you know, we clearly had some selling here around that $57 level, and we now got through it. So what am I doing here? I'm looking for a breakout to the upside. I'm looking for incremental increased movement, higher realized volatility, greater movement, but it only works if my options are on sale. So here's this chart that shows you implied volatility levels. It's an analytical tool that I use. The red line is implied volatility and the blue line is historical volatility. This is for 20 days. This is for 30 days. The reason I use 20 and 30, well, 20 days of historical volatility is based on trading days. Implied volatility is based on calendar days. There are 22 trading days per month on average. There are 30 calendar days per month on average. So these two actually go well in line. Now I look at Monster Beverage and I say to myself, gosh, I don't really see a lot of times where implied volatility gets below about 22%. And wow, realized volatility has been kind of in that 25 to 30% range for quite a while now. Maybe this is a nice opportunity for me to buy something on clearance that shouldn't be on the rack. So I went about a month out and I bought the $59 calls for 55 cents. I use my risk tolerance that I've set for the self. If I say it's $550 of risk, I get to buy a 10 lot. If I'm allowed $55 of risk, I buy a 1 lot. I buy one contract, $55 per contract. Then what happened? Well, the technical formation came through. We chopped a little bit right at that 200-day moving average for a couple of days, and then we exploded. So in just under 3 weeks, MNST rose from 57.30 to 62.17. About a 10% move. It's a pretty good sized move for a 24 vol stock. So on that day, I exited my calls for $2.74. That's almost 400% return in under 3 weeks. So on a $55 investment, I was making over $200. On a $550 investment, I'd have been making over $2,000. That's that life-changing home run potential there that I'm looking for. I only had, in this case, a risk tolerance of $550, and yet in 3 weeks, I make over $2,000. That's a really nice return. Let's do it again. I go through my process. I find the stock Endocyte. I like keeping this one on here, by the way, because you know what happened to this stock last week? Got taken over. $24 a share. So we're talking about this stock at $15 4 months ago. So I'm looking at this thing and I'm saying to myself, this little biotech that used to be trading around $7 is now at $14.86. Looks like it's breaking out. Well, I got a clear stop here at the bottom of the rectangle. I got my breakout at the top. What are the options going to allow me to do? Implied volatility is pretty stable here, around 80%, near the historical lows. Maybe I made a mistake here, though. HV20 was pretty low. Maybe I didn't, though. Because remember, that's low because we're trading in a rectangle. If this thing blows up, 150 vol, that's twice where it's priced right now. So I'm wondering about this potential for an absolutely crazy move, like it had a few months back in March. If that happens, I'm buying way too cheap a vol at 80%. And I know here that if I'm going to risk, say, $600 now, so instead of 55 cents, it's 60 cents, I can buy these July 20th $17 calls expiring in a little over a month. Pretty cheap. Got a good opportunity here. Looks pretty good if this biotech decides to go nuts like it did before. I have some explosive potential. So what happened? Not a lot. Here's the problem with the options that I talked about before. It's that opportunity cost, right? Because the stock sat for a good 3 weeks. So nothing happened at all. Didn't hit my stop loss level. Didn't break out. And then right here, finally broke out at the beginning of July. So if I had been entering on that day, probably could have made some money on these calls. Instead, because it took so long for the stock to move and it moved less than that standard deviation that I was targeting, I took a 25% loss. It's okay to take a loss. As long as I follow my process, I know that I'm going to lose money on these trades. Not everyone's going to be a winner. But when I get a winner at 400%, that certainly makes up for a 25, 50, 75, or even 100% loser. Because I only need one 400% winner to pay for 4 losers. Means if my average winner was 400%, which it's not that good, it's closer to 200%, then every winner is easily going to offset 1, 2, 3 losers. So right now I expect that my winners are going to offset 2 losers. So I only need a 33% chance to be right, of being right to make money. And I do better than that because I got that technical edge and I got that volatility edge. So here, didn't work out, but it's okay because this is the kind of setup that pays for it and more. GoPro was interesting. Kind of had 2 rectangles, right? We have the big rectangle using that May 15th high, something like that, and the previous lows. And then we had the recent rectangle that was starting to form in this area here between May 15th and May 31st, or sorry, the beginning of June 4th. On May 31st, the high was 568. That prior high there was just about $6. So when we broke out of this little rectangle, there was slight resistance there, but if we could get through both of these levels and create a short squeeze opportunity, it gets exciting. So no, this wasn't necessarily in an uptrend. Short term, very slight uptrend. Long term, there's been a downtrend. You can see that the 200-day moving average is down sloping. That tells me that recent prices are lower than historical prices. but we had some interesting setups here with this rectangle. All right, I got my stop here. I've got an intermediate price target, and then I got this explosive potential move. Let's see what the options are doing. Wow, GoPro volatility doesn't normally get this cheap. This is a 60 plus vol stock a lot of the time, and it's in the 40s. This is leverage. So I bought 3-week out options for 12 cents. With the stock trading 568, I could pay 12 cents for the $6 calls. Doesn't sound like a lot. And again, I can set my risk tolerance based upon the amount of money that I'm willing to risk. And I get this scenario where we break out and we took 3, 4, 5 days to clear that previous high and then blew out to the upside, all the way to $6.57. So on June 12th, I exited a little too early in the day because I sold these calls for 51 cents. Obviously, if I waited to the close, they would have been worth at least 57 and probably a couple cents more because of extrinsic value. But I made 325% in 8 days. I was happy to take that money, 325% in 8 calendar days. That is a quick move with a lot of money in my pocket. That's what I'm looking for. That's why I call this system the home run swing. I risk 1 to make 4. I started this system called the Home Run Swing Trader Trading Program. If you want to find out more, you go to optionhotline.com/homerun. You'll get all sorts of information. We're going to follow up with a replay of the webinar and with a special offer. And you're going to get that in your email tomorrow. Right now, go find out more about the program. Await my email. You're going to get a great opportunity here to join this trading program. If you have any other questions, love to answer them right now. All right. It looks like we are short on questions for the moment, but I'll give you guys another moment to kind of digest because there's a lot of information here. And I know you guys are going to have questions that come around as well. You can always contact us from optionhotline.com, contact support. I'll feel free to answer and we can figure stuff out from there. Anybody else have questions right now? I think we answered a few during the webinar. So if anything was missed, please repost it here and I can address it now. All right. I think that means that I've hopefully given you guys a lot to think about. Oh, there's a question here. All right. Why does the historical volatility fall when the price moves? So sometimes we get this scenario. I'll go back to a previous chart here, where even though the stock goes my direction, historical volatility can fall a little bit. So like, we look at MNST. We had 3 days of consolidation, then a couple big moves, and 3 days of consolidation, then a big move. That historical volatility is day-to-day movement. So these days of zero movement eliminate some of that historical volatility in terms of a measurement. I got the trend right. I got the direction right. So that made up for the fact that implied volatility, and implied volatility, by the way, went way up. So I had implied volatility go way up. The price went up, and historical volatility didn't. I got 2 out of 3. That ain't bad. But because I got the direction right, I didn't have to have historical volatility go up. I had a couple of days of big moves. That was enough to make this pay off so that 10% move can generate a 400% return. Oftentimes when you catch a trend, historical volatility actually is going down because you get a series of smaller moves in one direction. A lot of moves without a directional situation aren't always good for those options because I have a directional bias. So you can see historical volatility increased in GoPro because we had these big moves, these individual big moves. But this move and this move, net, about no change. That is an increase in implied or in historical volatility. Whereas in MNST, we just had 2 days of stagnation, 2 days of consolidation before the next big move. So that historical volatility can be misleading, which is part of the reason that I discounted a little bit when I've got a really nice technical setup. Because yes, you get a big breakout move followed by 3 days of zero movement, that's going to drop historical volatility. 1 day of 3% is really good for historical volatility on the 1 day. But if that's a 3% total for a total of 4 days, where you have 3 days of 0%, historical volatility is going to start to drop because it's calculated based on daily movement. There's a question about training videos. Yes. In the email with the replay, there is an offer for more training videos that we're offering for you guys that I think that you guys are going to get more value out of. It's a multi-part sequence, a lot of information covered there. I go into a lot more depth on this stuff because, really 45 minutes isn't enough to teach anybody a full system. It's just to give you guys an introduction and get you guys to understand some of how the value can be added in these markets. All right, with that, I think we're going to call it unless anybody has any last questions. I'll give you guys another 1 minute. So the clock is ticking. And then after that, you're going to have to just watch the replay, digest all the information here, come back to me tomorrow when you get your email with the webinar replay and the special offer, and then we'll go from there. All right, folks. Thanks again.